this warm, very warm week here in the GTA and across Canada. We wanted to do a quick webinar sharing kind of our top 3 questions that we're getting these days from clients. So we get a lot of sources and we listen on calls frequently with our portfolio management partners and our other partners in the industry. And we wanted to share what we're hearing about current state of things, outlook, and all that combined into a quick video. So we have myself here, Eric, and Jeff. So we're tag teaming this together, and we're going to be looking at your top 3 questions that are coming in these days. So your top 3 frequently asked questions. So without further ado, let's delve right into it. Question 1 revolves around inflation. Should I be worried about inflation?
Well, worried is a very good question. I don't think it's relevant unless you have a significant amount of debt right now. The thing about inflation is we don't have very much control over it, but we do have control over our spending habits and what we choose to spend money on and when we choose to spend the money. So let's leave debt aside. Most of our clients are in a very controlled debt environment, and that's not a worry. But if you are planning to build, if you are planning to travel, if you are planning a major purchase of a commodity that's in short supply, sure, prices might dissuade you, and it might be prudent to be patient and wait for a cycle or wait for things to adjust. Those people who drive electric cars, I'm sure, are thrilled right now. Energy prices have not been an issue. So, adjust your lifestyle to you and your spending habits to minimize the effects of inflation if possible, what you shop, what you buy, and how you buy it. And that's all you can do. If you're very tight debt-wise, if you're starting out or you're overextended, there's some serious conversations you have to have about how you can secure that debt to prevent further erosion of your cash flow to debt payments should rates rise.
Great thoughts there. Now, the second question is going to tie into interest rates. So what's going on with interest rates? And interest rates and inflation are closely linked. But what are your thoughts on interest rates, where we're going, and what that means for clients, their debt picture and portfolios?
Yeah, well, interest rates, okay, I've sourced this slide that you can see here to give you a sense of where interest rates were prior to the COVID years, how they were, and also during the last financial crisis, how low they went to basically stimulate the economy. The way the world is structured, certainly the free world, and one of the reasons for the Great Depression back in the day was that money stopped being spent. And if money isn't in circulation, employment changes, demand changes for product and services, and this whole thing spirals in a negative way and basically can cause a recession or a depression, in fact, when people lose jobs in a significant manner. So what the governments have learned over the years was in times of crises, you want to make sure the liquidity is there. And that's what the governments in the free world have done. In Europe, in the US and Canada, they dropped interest rates to provide liquidity. They made payments to, in Canada it was a CERB, in the US they paid directly to families as well, and provided a lot of liquidity, meaning there was money out there in circulation that was being spent. And now that the crisis is over and there's all this, in essence, there's a lot of surplus cash, and the economy can't ramp up as quickly as we need to, basically, to spend this money or to produce these products that are in demand. This is inflationary. It's causing inflation, basically allowing companies to raise prices simply because the demand is greater than the supply. So they do have to be normalized, and that's what we're seeing. So, I mean, you know, in my day, when I got out of university, we were looking at buying houses at interest rates of 13, 14, 15%. They were down to 6% in, believe it or not, in 2001, and then came down as low as just above zero. I think it was 0.75 in Canada, 0.25 in the US. So normalizing would mean inflation plus 2, somewhere around 4% would be a normal rate. So the fact that they're going up to 2.5 or 3, you know, is negligible, really. It shouldn't be a major issue. You know, there is an element of overreaction there, but this is what I would consider normalizing. And you want to normalize rates because should you need to stimulate the economy down the road, you got to have room to work with. So, you know, in the short run, we're seeing a lot of reaction, maybe overreaction. In the long run, I'm hoping, desperately hoping, that the Bank of Canada gets it right, as well as the Federal Reserve in the US and in Europe, and they don't overcorrect. We adjust accordingly.
So in short, a little bit of short-term pain with this, but ultimately the bank is trying to give put some cannon back in their arsenal in the event that the economy does need some additional help.
Absolutely, and take some liquidity out of the market that they pumped in to account for COVID and that crisis.
Okay, so tying all this together, I mean, inflation, interest rates, those are the big worries or hot button items. How does this translate to investments? I mean, so now how does that affect the landscape? Does that affect our estimates for what returns could be like? Let's bring this all together and see what does this all mean for our investments and for our client portfolios?
Right. So what we're seeing now, as we saw in the first few months of the COVID crisis, is a correction in the equity portion of the marketplace. And also in the bond portion, because when interest rates rise, bond prices drop. So, you know, these are unavoidable, and these corrections happen more frequently than I think we care to recognize. And this chart, I think, points that out quite well. The blue dots show during any given year what the maximum decline was in the S&P, and I think it's surprising to see that. And the blue bars show during any given year what the year end the maximum return was during that year. So there is a fair amount of volatility because there's a fair amount of speculation generally in the equity markets. We don't build portfolios and manage portfolios on speculation. We manage them on profitability and growth. So the short-term chop that we see doesn't really concern me. It's longer-term trends that we're really interested in, because these portfolios for most of our clients are built for their retirement or for major capital expenditures. And we can't speculate on the short term. We're not day traders. What the real question should be is, you know, do our portfolios react to this, and how? And how will this impact our retirement or our income needs, or the income generation options from the portfolio when we retire? And the short answer is, by not reacting, you are almost ensuring that your long-term plans remain in place. When you feel you have to react, or you feel that there is a need to respond by changing your investment horizon, or by getting out of certain investments that are sound, it ultimately will bring down your overall return, your longer-term returns, and not provide the income that you're looking for down the road. And we have both retirees who are living off their portfolios and see the movement in their overall portfolio values. And we have people that are building up their investments and savings so that they do have funds down the road. If you're on the saving side of the equation, these corrections work in your favor. You know, our mandate is to work with portfolio managers that are constantly looking for profitable businesses that are growing, and don't really speculate on startups and small businesses and the flavors of the month. So if we can get profitable businesses that are in growth sectors on sale, down 15%, down 10%, and we're buying on a regular basis, that over time works way better than having to pay elevated or excessive prices for the same business. So I encourage our savers to continue to save, especially in these declines, and I encourage our retirees to maintain their focus and not worry about the short-term volatility in the marketplace if they don't want a real change in their standard of living.
That's great. And then lastly, we often get a question about, we see so much volatility in the market, especially this year. So what are we doing on an active side of it to either to react or to prepare for all these different kind of market flows? So just to address that in the sense of, do we need to move? Do we need to make changes? How do we think about that in the context of the investing environment?
Right. So that's a really good question. And the reason that we don't have to necessarily buy and sell individual funds or individual asset classes is because the way we've assembled the portfolios, the portfolio managers themselves have the ability to make changes in the types of investments that they make within the portfolio and the weightings that they have between certain asset classes, bonds to equities, dividend stock to bonds, et cetera, et cetera. So we don't have to override. They're doing that already on our behalf and reacting much faster than we could on an individual basis. And this happens to be a global growth portfolio, and you can see all the different asset classes they have to work with: Canada, US, international, emerging markets, commodities, and all the different types of stocks they have to work with. And then how you can see by the small diamond 3-month prior position and their current position, how they reposition in as short as 1 quarter where they want to focus their funding. So that is being done regularly on our behalf. And Erik, if you switch to the next slide.
One thing to point out here, I mean, you touched upon using this time, if you're in saving mode, to be buying into the market on the cheap. This is what the institutional portfolio managers who are managing the billions of dollars are doing. I'm just looking at the CAD here. And since the last 3 months, that amount of Canadian dollars has gone down by 5%. So what this means is that this institutional management team has been deploying this cash into the market. So essentially taking that advice, and they're doing it because they see valuations have come way low.
And there's another point that I think is overlooked, because a lot of people, when they see equities, they see the index and they don't understand really what they own. And in a portfolio, you basically own stock, companies. Profitability in companies is what you're buying, and you're interested in the prospects of those individual companies. For a lot of reasons, good companies get sold in downturns that have nothing to do with the profitability of the company. For a lot of investors who are speculators out there, they may have to unwind or get out of positions where they've bet wrong. Basically, they've speculated on something that's in a market that's correcting is going to cost them a lot of money. And to get out of those situations, they have to sell their good companies, because that's the ones that have value. They have to sell their banks. They have to sell their insurance company holdings to generate the cash they need to get out of bad positions. Our managers are looking for those opportunities. They'll buy those up every day of the week because they know what their true value is, and they know that value will return. So if you're forced to make a sale, there's somebody out there who recognizes that value and who will buy, because they have a longer time horizon than you do. So we don't want to be in that position. Our clients don't need to be in that position. And this is what's happening behind the scenes. And here's another example. So this is Mark Schmelz. This is more of a smaller cap situation, but you can see if you look at just December, Eric, if you put your pointer on December 31st, in information, he was high in IT. And in 2021, the fund return was what, 91% or something for that year?
Yeah, so Mark Schmel, he manages
ridiculously high.
Global Innovators, and we hold that in a lot of client portfolios as kind of a disruptive sleeve. It was the #1 performing holding fund.
Right. Now if you fast forward 5 months, they've seen the overvalue in that sector, and they sold it, and they've redeployed it down to 5% into other sectors, i.e. Consumer staples, energy, financial services, and utilities. So that's all happening behind the scenes. We didn't have to make any wholesale changes on the face of it, but it's all been done. All that work has been done behind the scenes so that we can generate those long-term returns that we need to live on. So I'm hoping that with a little more in-depth view that we've provided, that provides some clarity for our clients. And as always, Eric and I and Per are more than eager to speak to you one-on-one or answer any of the questions that you may have that pertain to you personally.
Wonderful. So we just wanted to share our thoughts on all these different hot button items. And if anything resonated with you, or you did want to have a chance to book a meeting and review your holdings, your portfolio, your plan, if anything's changed, please reach out. We'll have our Calendly bookings, so you can book directly in our calendars, set a time for us, and we'd be more than happy to see how summer's going, do a review, and chat with any of you. So thanks again for everybody for spending the time, Jeff, for the insight, and to all our partners.
Thank you, Eric, for hosting.
And we will see you again.
If you like the format, we'll do it again. Just let us know how you like the format.
All right. Thanks, everybody.